Is NVDY actually profitable? We're going to take a look at that and all the other ones in Group B and find out how much we're really making on each. Hello my friends, this is Legend. Today was the X date for Group B and they will pay out on Monday, January 6th. But I wanted to do a video here just to kind of go through these in Group B. A lot of people can get confused or misled in how these ETFs in the YieldMax actually work, as some of them are profitable and some of them are at a loss currently. I wanted to go through each and show if they're up, they're down, are they profitable or not. So let's jump right into the ones that pay out weekly, and that's YMAX and YMAG. Here on YMAX we're showing, and I'm showing the full chart. Even though the 5-year is clicked, YMAX has not been out for 5 years, nor has any of the other YieldMax ETFs. So if you look on the chart here, you will see at the very bottom corner where it says, in this case, January 2024. That is when it first came out. So each one that we'll go through will show that date at the bottom, just in case I don't call it out. It is not for 5 complete years. It is from the time that it came out. So on YMAX here, we can see on the price, it is down 15%. And then when you add the dividend back on top, we are up 25% on this one. Now, the 25% here is if you are keeping that dividend. But if you are rolling it back in, or you're using that dividend, cashing it out, or reinvesting, then the YMAX in itself is going to be down 15%. It is profitable, but the actual price itself has dropped 15%. So the amount shown on your portfolio, on your broker, will show you as 15% down on the price, assuming you bought it at inception. That would change depending upon when you actually got in. So in this case, you would be down 15%, and that's what would be shown. The dividends, of course, would come in on a separate line item, but if you added those back in, you would be up 25% on this play. But really what we're looking for is that stock price to stay flat or to go up, because as the price is going down, in this case down 15%, that does show a negative in your account. It shows as you're down 15%. It's just when you add that dividend back in, you can calculate that as being up. But we really don't want our account to go down. We would like our account to either stay flat and get the cash flow off of that ETF at a percentage additional to our account to raise our account, and then you can take that and you can reinvest that how you see fit. But in the end, we really don't want that price to drop. We'd like for it to stay flat so that the dividend is a positive cash flow, or we would like that price to go up, and of course the dividend would be up higher than that, so that again would be a positive cash flow without draining that ETF invested amount. So for YMAX here, like I said, we're down 15% on the price. At the dividend, we're up 25%. So this one here, we'll see how this one plays out. If it can bottom out and start turning back up a little bit to get back up close to that $20 mark, that would be ideal. So YMAG here is actually doing a little bit better than the YMAX. The YMAG is actually somewhat flat on the price, like we were saying earlier. So if it's coming out around about, well, it's about $19.50 and it's at $19.18 now, you can see that the price is only down 1.5%. So then when you add the dividend back in, you're up 38%. So this one here, basically when you look at your portfolio, and if you have one share at $19.50 and the price now is $19.18, then you've only lost 32 cents per share on this one. but you have made 38% in the dividend or the distribution. So that means that this is a better deal. Now, this one does only contain the Magnificent Seven, which they are more volatile than the overall YMAX, and they seem to have been doing better than the overall YMAX funds because it does take into account of all of them, right? So not all of the YMAX funds are good, so therefore that might be why YMAX is being pulled down so much, whereas YMAG being a better overall investment. So between these two, I think YMAG is probably better than the YMAX. I have the YMAX, unfortunately, and I do not have YMAG, but I was looking for more of a overall diversified fund, and the YMAX gave me more of that diversified fund. I just wish it was doing a little bit better. All right, now we're at NVDY here. On NVDY, you can see we are up in the price, and this is May 2023, up in the price by almost 5%, and when you tack on that dividend, you're up 173%. Now this is a nice one. This is a nice move. A lot of people talk about the NAV erosion, and this one here, I'm not seeing it. Now it's at 23.90. Could it be going back down and testing a little bit on the lows? It could be. Or could it be going back up? It doesn't matter at this point as long as it stays within this range and it stays somewhat flat or going up, then that to me is exactly what I'm looking for in these ETFs. I'm looking for something to stay flat to up. Either one of those is going to be a better investment. So I'm not seeing NAV erosion for NVDY. As you can see, it's staying flat. I prefer it to go up, but staying flat is what you're looking for on these. You're looking for it to stay flat or to go up on that price, and that way you are not losing on the overall capital of the investment and only earning your dividend or distribution on top of that. So staying flat to go up on the price is what I'm looking for on these ETFs. Dips. For dips here, as you can see, the price alone has gone down 37%, and when you add that distribution back on, you're down 24% still. So in this case here, and it's been out since July 2024. So an example here is if you had $100 worth of dips at inception at today's time at a 37% down, the ETF would be worth about $63 in your account, whereas you had $100 invested. Then if you tack on your dividend and add that back in, you're still down. It is now $76 valued even after you add that dividend back on. So that's what I mean by as far as in NAV erosion. This one here is seeing a bit of NAV erosion. It has only been out for about 6 months, but it is not heading in the right direction so far. So for me, dips is a no-go. I would have to see this one flatten out before I would think about this one personally. FBY. On FBY, you can see here we're looking at this price, and that price is pretty flat. It's down 5%, so not too bad on this one. You came in just above 20 bucks, and we're at 1938 now. According to this chart, it came out in July of 2023. So with this one here, you're down 5% on the price, and then you add back in your dividends, and that takes it to 71% up. So this one here is a good example of a good cash flow. Price-wise, it is staying relatively flat overall. Down 5%, it's not too bad, and you're up 71% when you tack on the dividends. That's along the lines of more what you're looking for on something like this. So the ETF is staying flat itself, but the dividend is going up, so you're making money there. So that makes for a good cash flow. GDXY, again, here we're seeing a 22% down on the price alone. Tack on the dividend, you're still down 6%. So again, This one here is a no-go for me. Just like last time, if you had $100 worth, currently it would be worth $78. Then you tack on the dividends back in, and you're still at a $94 value. So you're still $6 under what you invested. And for me, that's not going in the right direction. BABA is the underline for Babo. And Babo here, we're seeing we are down 16% with the dividend. We're pretty much of a break even. Not really very enticing if you are just getting repaid your money in a distribution. I prefer to make money versus just get repaid my money that I invested. And right now, currently, that's what Babo is doing. It's just returning your invested money in the form of a distribution. So that's a no-go for me. JPMO, now this one here, we're down about 10%. And then tack on the dividend, we're up 19%. This one here, there's worse ones, right? You're down 10% and up 19 on the dividend. So it's not too bad. It's a little slow. It has been out since September 2023. So the time period that you have had this invested and only be up 19% over that time period is a lot of risk for the amount of time that you have been invested in this one. So for me, I am not a fan of that. I prefer to get a better return on my invested amount of money. At 19% over a year, year and a half almost, I guess, close to it now, to make 19% is okay. Not great, just okay. For Marnie, I don't think I would be too happy with this one. This one here looks like it came out just under the $20 mark or maybe right at 20. And price-wise, right now, it is $5.30. This one here is not good. That's a terrible erosion of the price. You're down 72% in the price alone. And then even when you tack on your dividends, you're still down 49%. So you're still down almost half of your invested amount, even when you calculate the dividend back in or the distribution back in on top of the price erosion. So for Marnie here, not a fan of this one myself. PLTY. For PLTY here, now this one is fairly new, came out in October. This one here was around about, looks like maybe the $50 mark, and currently the price is $70.45. So this one here in price wise, you're up 43%. Tack on the dividend and you're up 56%. So this one here is exactly what you're looking for, even better than the FBY, because you're getting price appreciation along with your dividend or distribution. Whereas FBY, you were flat on the price, but getting a decent distribution. For PLTY, currently, it's the best of both worlds. You're getting good price appreciation and you're getting a good distribution. So for me, I like this one. I am in PLTY, and they did just announce their dividend, and it was a very nice dividend, and I did a previous video on that one, so check that out and see what those dividend amounts were. And the last one, Morrow. For Morrow here, it's only been out for about a month. They did announce their dividend as well as part of the Group B distribution list, and they are paying out a nice dividend. They're paying a nice distribution, but the price has dropped pretty drastically. It came out at around that $50 mark. It went up and then it fell back down. It went down as low as the $38.79, about where it's at right now. So this one here, it is fairly new, and it does have the underline of Mara, and Mara is very volatile. So the distributions will be nice on Morrow, I imagine, but because Mara is a Bitcoin play and Bitcoin being very volatile, Morrow will also probably have some very violent swings. But Morrow is still fairly new and not a whole lot of data on Morrow currently. So currently it is down. That dividend will bring it up just a bit, but I think overall it's still going to be showing as down. So currently for me, Morrow is a pass until they can figure out and get a better handle on those option plays. Because Morrow can violently swing up and down, they're going to need to shoot those strike prices out a little bit. If they try to play it too close to get that really juicy premium, they're probably going to get in trouble as far as in having to pay to close because of the violent swings of Bitcoin. And in 2025, I think we're going to even see more moves on Bitcoin. Well, that completes the list for the Group B ETFs. We saw some good ones and we saw some not so good and some that were fair. Do you have any in Group B? I imagine a lot have the NVDY. That was one of the bigger ones. There's a lot of people in NVDY and are probably sitting pretty nice with NVDY. It has been profitable and it is going up to staying flat on the price, but that dividend or distribution is nice. So that gives you a positive cash flow on NVDY. And I like PLTY for myself. So far, it has provided the best of both worlds. Nice appreciation along with nice distribution. And for the weekly one, YMAG, I think is the better one between the YMAX and YMAG. So I think I'm going to wrap it up right there. Don't forget to like, subscribe, and share this video. And don't forget to hit that notification bell to get notified of any new videos that get uploaded. So as always, I am not a financial advisor. This is not financial advice. Please do your own due diligence before you get into any stock plays. And until next time, Legend out.